Now let's start on the bottom of the continent, where the implementation of the controversial e-tolls on major South African highways in Gauteng province starts at midnight on Tuesday morning. Now, for all intents and purposes, the e-tolls are a done deal, but there are many South Africans who feel the toll could have been added to the tax they currently pay for every litre of fuel they use. With a closer look at the mixed feelings these e-tolls have stirred up, here's CCTV's Angelo Coppola.
With a little over 700,000 e-tags sold, that's less than 30% of the potential Gauteng highway users registered for the system, opponents say that drivers are showing their displeasure. It has a lot to do with the additional cost. It's estimated that regular users will have to fork out an extra $50 a month to pay for those tolls. But it's more to do with the method of collection, which has been rejected by political parties, unions, non-governmental organizations and church groupings.
And we know that there's such a level of anger and outrage all over, in all levels and sectors of society, from all spectrum of political opinion as well. And if everyone stands up together, we know that we have nothing to fear.
Citizens from other parts of the country using Gauteng's roads won't escape the e-tolls either, as the system works off the National Motor Vehicle Database. What remains unclear at this stage is how e-tolls will be collected from foreigners using their own vehicles who are visiting the country.
It's actually incredibly difficult for them to keep track of locals, and the system is built on recognizing a registration, linking it back to a database, and then being able to track the person down. So I suppose in principle they could try and track down a foreigner who came into the country using that registration, but it's very unlikely. The system is very cumbersome. The likelihood of it being able to deal with that sort of complexity is very small.
Social disobedience is not new to the 17 church leaders. They are aware of the consequences that they may face. The signatories were quick to acknowledge that not all church leaders endorse their protest action. There is also a level of fear of the legal and financial consequences of their action.
There are some lawyers who are willing to come to the party and are willing to take the matter to court and to test whether this will be acceptable in court. So we hope that those lawyers who have made that commitment will also be able to come through.
Despite the vocal rejection of the collection system by public interest groups, the discount incentives may well mean that many Gauteng road users will register and buy their e-tags. On the other hand, many feel that the toll could have been added to the tax they are currently paying for every litre of fuel they use, saying the collection system is inefficient and too expensive.
What is clear is that protest action is set to continue despite the outcome of any legal challenges. What's also clear is that the ANC government is not listening to its alliance partners, but the labour unions are confident that the government will listen to them, eventually. I'm Angelo Coppola for CCTV on the highways of Johannesburg.
Now, Nigerian authorities have moved back the date to announce revised GDP figures from the 10th of December as initially planned, back by at least 2 weeks. Now, some analysts do expect the revision of GDP data to make Nigeria Africa's biggest economy. Others, however, simply expect it to close the gap between it and South Africa. Now, this exercise, however, does raise some key interesting questions. For example, what will presently rocky ties between South Africa and Nigeria look like after this new GDP data comes out? CCTV's Sumitra Naidu has some answers.
It's a rivalry that goes back over 2 decades. Earlier this year, Presidents Goodluck Jonathan and Jacob Zuma met on the sidelines of the World Economic Forum, pledging to patch the rocky relationship with a range of bilateral agreements, including looking at the relaxing of visas between the two countries.
There is no need for rivalry between the two countries. It's unfortunate that the two countries, you tend to seek on healthy competition between the two countries. These are two big economies on the continent of Africa. They will do well by cooperating, by working together.
According to a Standard Bank report released earlier this year, business ties between South Africa and Nigeria have been boosted, with trade growing 12-fold in just over 10 years. Total trade now stands at more than $3 billion, but there is still substantial room for growth.
Something that comes across both in South Africa and in Nigeria is the question of economic inequalities. As we see more of economic growth, we also see higher levels of inequality. And it does not have to be. Economic growth can come with reduction of inequality.
With Nigeria now poised to overtake South Africa as the continent's #1 economy with a rebasing of its GDP, experts believe the two nations should use this as an opportunity to help drive economic growth on the entire continent.
The two countries should look at Europe. France and Germany have actually driven the regional integration process in Europe a lot. And I see Nigeria and South Africa driving the regional integration agenda on the continent of Africa.
While there is no concrete evidence that the relationship between the two countries has been smoothed over since the two presidents met in May this year, there's no doubt that Nigeria and South Africa will have to work together for the greater good of the continent. Sumitra Nadu, CCTV, Johannesburg.
Now, economists in Nigeria say that at the moment, the reference points used for calculating Nigeria's economic statistics are pretty much outdated and no longer really useful for any proper in-depth analysis. As CCTV's Deji Badmus reports from Lagos, despite the high GDP figures some do expect, there's still a lot more that needs to be done to improve the living standards for ordinary Nigerians.
The last time Nigeria rebased its GDP was way back in 1990, some 23 years ago to be exact. The population at the time was just around 88 million. Today, it has doubled. The telecoms industry as we know it today was non-existent. The number of big businesses in the country back then could have been counted on the palm of one hand. Today, all of that and many more have changed. The more reason why economists and financial analysts are welcoming the decision by the government to rebase the GDP.
Take the ICT, take the services sector, take the entertainment industry, take the construction industry, take even the hospitality industry. You know, a lot of these sectors have transformed significantly over the years.
It is mainly because of these and other reasons that there are projections that the country's GDP may record a significant rise after the rebasing.
Presently, our GDP is in the neighborhood of about 300 billion US dollars. I see it moving close to around 400 billion.
But that positive outlook is hardly reflected on the streets of Nigeria. A recent report by the country's National Bureau of Statistics put the number of people living below the poverty line at 112 million out of a population of around 160 million. At the same time, the Bureau also reported that the country's real GDP grew by 6.81% in the third quarter of 2013. It's this paradox that most people are finding difficult to reconcile.
They give all these figures. I don't have any problem with it. But the problem really is we have growth without development.
Currently, South Africa remains the biggest economy in the continent. But with its consistent growing GDP, some argue Nigeria may be staking a claim for the #1 spot after the rebasing. Not everyone, though, sees things from that perspective.
Your growing does not stop South Africa from growing. South Africa's growing does not stop you from growing. So you should be more concerned about how are the people in your country, the 150 million people in your country, are they better off today than yesterday?
The National Bureau of Statistics has said that the rebasing exercise will cover 46 sectors. And some analysts are already forecasting a significant rise of about 40% after the rebasing. Everyone, including the international community, is waiting to see how everything pans out eventually. Deji Badmus, CCTV, Lagos, Nigeria.
Clearly then, plenty to talk about on that subject. Let's get you some global perspectives. Miriam Bema joins us live from London, while Babatunde Omilola is a senior economic advisor with the United Nations Development Programme. He's live in Johannesburg tonight. Mr. Omilola, let's start with you in Johannesburg tonight. Given the event we've seen from the other rebasing exercises in, say, Gambia, for example, or Guinea-Bissau, just how much do we really know about the size and the activities that underpin Africa's economy?
We really do not know a lot about African economies today in terms of the market value of all the officially recognized goods and services in many African countries. The reason is because of the informality of many African economies. And we also really do not know the level of private consumption in many African countries because of the informality of many African economies. As you must have seen from the whole rebasing exercises that have taken place in many African countries, and the one that is currently taking place in Nigeria, we have seen that right now, a lot of African economies have not been calculated properly. And the one reason for this beyond informality of these economies is the fact that the African economies are diverse, and also because of the fact that if you look at the example of Nigeria, as I said earlier on, currently the GDP stands at $272 billion US. But when this rebasing exercise is concluded, it will be around over $340 billion, or even up to $420 billion US, which might overtake the South Africa's GDP, which is currently standing at around $384 billion US.
Indeed. Miriam, delays in this exercise aside for the moment, what sort of changes do investors on your end expect to two key ratios, tax as a percentage of GDP and national debt as a percentage of GDP?
Well, you know, really, Rama, investors are hoping that the rebasing will make Nigeria's balance sheet look better and actually simplify it really more than anything. Now, many economic indicators rely on the GDP. So if we see a large upward revision that will ultimately impact other variables, it becomes a balancing act for the Nigerian government, really. On one hand, GDP per capita would be higher and the ratios of debt, foreign direct investment, and the current account to GDP would likely be lower. In return, this would mean lower costs of borrowing, ergo attracting more investors. Right now, Nigeria's tax laws are very complicated and often discourage foreign investment with high costs of doing business. Ultimately, investors will be keen to see if the adjustments will, in fact, improve their returns.
Indeed. Mr. Omilalo, given the fact that early in the year South Africa, of course, did face an aid cut from the United Kingdom, isn't it likely that if the rebasing of these GDP figures essentially tells us that Nigeria's economy is much larger than previously thought, that Nigeria might face essentially a similar problem, aid cuts from all its donor partners across the world?
It's very likely that after the rebasing exercise, Nigeria may no longer be able to receive aid from many developed countries. But at the same time, I think Nigeria needs to look inward in terms of domestic resource mobilization. Nigeria has a lot of natural resources, as you must have seen, and we can actually utilize a lot of resources that are mobilized locally to fund development in Nigeria, and the same for South Africa as well. But having said that, I think the developed countries, the development partners, shouldn't really cut aid from these countries, because Nigeria and South Africa have dual economies, in the sense that inequality is very high and unemployment is also very high. We have in South Africa, for instance, certain parts that can be categorized as developed, but certain parts of South Africa are also developing, and they actually require assistance in such places. The same goes for Nigeria. So I think we have to find a way of balancing partnership alongside domestic resource mobilization at the country level in Nigeria, in South Africa as well, and also resources from the developed countries. We have to find a balance there.
Indeed. Thank you very much. Coming to you in London finally, Miriam, the fact of the matter is the larger economies are, the slower they tend to grow. But authorities in Nigeria seem very confident that they can maintain some pretty strong, high single-digit growth figures. Do the analysts on your end agree?
You know what, it's everyone on this end is really taking an air of caution right now. The common expectation is for Nigeria to find a way to generate enough revenue to boost economic growth and development. An upward adjustment to GDP could potentially lower government revenues. That's one downfall that perhaps people are looking to see whether it will be a downfall, a pitfall, if you will, which would put it under the average for sub-Saharan Africa. At the same time, Nigeria is trying to move away from its dependence on oil, which accounts for about 40%. It's one thing to maintain a high GDP growth rate. It's another to support domestic purchasing power, for example. And we were just talking about creating or sustaining that balance. If the tax system is simplified and the government can remove concerns over things like double taxing, this will lower the overall cost, reduce the burden, and increase consumption, which in turn would also help maintain the GDP growth, which in turn would also attract, of course, more investment.
Indeed. Thank you very much for your insights this evening, Mr. Babatunde Omilole from the United Nations Development Programme, and Miriam Bemad live in London. Now let's move on from conversations about Nigeria and South Africa to another country in the continent. A large number of Zimbabweans are spending their days in unbearably long queues trying to withdraw their money from banks. This is just a latest symptom of cash shortages that do continue to plague the country. A long-standing liquidity crisis combined with a year-end peak in demand for cash have both caused these enormous queues to fall. CCTV's Farai Mokutuya has the details.
These scenes are reminiscent of a 2008 cash crisis which was fueled by record-breaking inflation. Back then, Zimbabwe used its own currency. Now, trading in multiple currencies, the shortages are a result of low economic activity, which, due to its informal nature, means that the little funds in circulation do not go through the banks.
Many of the people here tell me that they have been in this queue hours before the bank even opened its doors. There is already a sense of frustration here, but they still have a long wait ahead of them. And even then, there is no guarantee that they'll get the amount that they actually want.
Some of the worst affected banks are limiting how much customers can withdraw.
I only managed to get $200 today. They're limiting withdrawals irrespective of whether it's a personal or company account, or if you have money or not.
Not all customers are fortunate enough to even get the restricted amount. Only a handful of clients were served at this bank, the rest told to try again the following day. There is some good news for the struggling banks. Cabinet this week approved the takeover of a 1.35 billion Reserve Bank of Zimbabwe debt by government in what should pave the way for the smooth recapitalization of the central bank. Experts say the Reserve Bank's failure to play its role of lender of last resort has compounded the cash shortages. The plan is to issue treasury bills to the banks in return for money they are owed, allowing them to borrow against those treasury bills and get more liquidity.
The problem is, where's that liquidity going to come from? Liquidity is restricted by basically our foreign currency earnings, and they're down 10% or so. Imports are up roughly the same amount. So there's a squeeze on the balance of payments, and it's that really accounts for the problem of liquidity.
The way forward to ease the challenges is to increase exports, attract foreign capital, and get international lines of credit. Exports can be increased by resuscitating the manufacturing sector, which is operating at below 40% capacity, while wooing international capital may prove harder to do. Farai Mokutuya, CCTV, Harare, Zimbabwe.
Right then, quick run through the markets now for you. And aside really from West Africa, the rest of the bourses that we track here essentially started all on a negative note. The all-share index in Nigeria up by about a third cumulatively over the year. That's about 30 or so percentage points higher year to date. The JSE all-share index in the red, down half a percentage point. Pretty much the same story really in Nairobi, with the 20-share index down by a comparable margin, but still well above the 5,000 point mark. A bit of profit taking happening there. And the Egyptian market, the EGX 30, also down by about 0.3. We'll have more business for you tomorrow at 10:00 GMT.